Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He is the managing director at Wind Rock Wealth Management. Christopher Casey, thank you for joining me.
Thanks for having me, Jason. Looking forward to it.
Yeah, and I'm interested in hearing exactly what an entrepreneurial-minded advisor is because I've been a stockbroker and normally they're just salespeople. So I'm interested in hearing how your company is different later in the interview. But first, let's talk about Brexit. There's just been so much going on with Brexit. Do you think it's good for freedom? What are your thoughts on Brexit?
Well, you're right. I mean, everyone's talking about Brexit right now. It took everybody by surprise. That's for sure. Whether or not it helps with economic freedom, I don't know. I mean, all things considered, to leave, the dead hand of Brussels and their regulations and their subsidies that they're extracting out of Great Britain, that's definitely a good thing. The issue, though, is what they replace it with. I don't see, the next Margaret Thatcher or the like in the UK right now. There's certainly the reasoning behind leaving the EU. I think it had nothing to do with free markets. It was more driven by, other working class concerns, immigration, et cetera, and just the fact of how their lot is faring recently. So given that they've left the EU, that's all things considered great. But really the question is what happens next? And to the extent that they wind up with a regulatory and fiscal policy that's worse than what they were already enduring, it could be worse for freedom. But on the net, it sounds like it's good. Time will tell.
Yeah, Jeff Dice at the Mises Institute, I don't know if you saw the article. He wrote an article about how nationalism is better than globalism and that individualism is better than nationalism. But I think you brought up a great point there about the British government. Even if with the independence that they have from the European Union, the central planners, the politicians, the bureaucrats, the central bankers in Bank of England, like was just announced today, it seems they're, hell-bent on intervention in terms of, taxes and devaluing their currency and things like that.
Yeah, well, in times of uncertainty, they take the same playbook that's passed around worldwide by all central bankers, right? So we see this in Japan. We've certainly seen the United States. We've seen it with the European Union, and unfortunately with China as well, despite their long kind of recent history embracing free markets and capitalism. And that playbook is pure Keynesian economics. It's let's devalue our currency even more by printing more money in the hopes that somehow it spurs exports and thus fuels some type of growth within the economy. And, all things being equal, it will help certain industries, but it's at the expense of others. And the net effect is a negative for the economy as a whole.
Exactly. And, the long-term effects are of mercantilism, which is what Keynesian economics is partially based on, is that the savers and investors, the people in England who are trying to do the right thing, they're going to get screwed if they're holding British pounds or British bonds or things like that.
Well, I'm glad you used that term because mercantilism, a lot of people grow up learning about that in the school books and thinking that it happened, centuries ago, and that's kind of a discredited and discarded economic theory, when in fact it's simply been repackaged. I mean, we see this all the time. I remember George Bush, the first one, saying, he wants America to be a great export powerhouse. Well, in reality, we want to be an import powerhouse, right? We want more goods and services, and we want to pay for them, and you want to export as little as possible to get that. So it is kind of a warped mentality, and it's purely a mercantilist mentality that unfortunately is still around. I'm glad you used that term.
Yeah, imports, exports, I don't really care which one as long as the free market's allowed. What we have, though, with so many governments, Chris, is we have these protectionist policies. Even Trump is talking about it in the elections now, that he thinks his solution is, we're just going to put these huge tariffs on Chinese goods, and that's going to bring jobs back. I mean, with these politicians trying to force higher minimum wage laws and automation becoming cheaper and, this artificially cheap capital, I don't think we're going to have as many of these manufacturing jobs come back. I mean, there'll be some, but there's not going to be this massive amount of ones. So I think, these politicians with populist arguments, they it's not just Trump in the United States. We've seen it countless times in so many other countries. They promise jobs and they say, we're just going to put tariffs on foreign goods and that'll solve the economy. And history has proven, whether it's Smoot-Hawley or so many others, that doesn't work either.
Well, what those politicians should do is take it to its logical extension, right? The logical conclusion of this theory that somehow protectionism and these trade tariffs will help industries. Why don't we have trade tariffs between each and every one of the 50 states? I mean, if you're really concerned about creating jobs and you believe that's the way to go about it, then don't stop at the national borders. Let's create it every state, right? I'm sure that'll work out great. Um, it's unfortunate because this is one area of economics that should have been put to bed a long time ago, and it's that free trade helps everyone. Unfortunately, what's been distorted over the years is that people don't also recognize that free trade equals fair trade. So this starts talking about, well, to have free trade, you have to have these labor agreements, environmental agreements. We're only going to lower tariffs if they lower tariffs. And that's actually the antithesis of free trade. Free trade exists without government compacts between governments. It will exist just from firms trading with each other. Government simply needs to get out of the way, not do anything proactively.
Amen. Do you think the Brexit vote, the outcome of it, do you think it surprised the economic and political elites and the bureaucrats in the European Union? Do you think any of them were actually prepared for the outcome of the vote?
I don't. I mean, there's some people that have conspiracy theories that thought that they wanted this ultimately, etc. But my thought is, think about these elites. The whole reason people voted for Brexit has nothing to do with issues that are even on the radar screen of these elites, right? They're not dealing with immigration issues. They're not dealing with the fact that people have household incomes that are probably just about pre-2008 levels and then have increased, or increased marginally since then. They're not dealing with high unemployment rates, which are just horrific across Europe. And so I'm sure the elites were prepared because they're so distanced from the concerns of the populations that they have. And we saw this based on their reactions. We saw this with, the way the votes were moving, the polls were moving right beforehand. I'm sure they were shocked because every indication was the momentum was in the favor of staying within the European Union.
Yeah, I think the plan has been to add Britain to the to add England to the euro. I think Jim Rickards mentioned that if the vote had gone in favor of staying in the European Union, that they were going to start working on getting rid of the British pound as a currency and assembling them into the euro currency too in the next couple of years.
Well, that would have certainly been unfortunate. I mean, it's bad enough. I mean, there's basically three ways the government intervenes in the marketplace, right? There's monetary, fiscal, and regulatory policy. And they had a huge dose of regulatory policy from Brussels, that's for sure. And they were tied in fiscally to some degree. But once you tie in to the monetary union, then everything's over, right? Because you have no control over not just the monetary realm, but also the fiscal realm, because you're tied at the hip.
Yeah, and it becomes constant currency devaluations again. But I mean, even the Bank of England now, post-Brexit vote, wants to devalue their currency anyway. So I did a video last week or the week before. I don't know if you saw it. Well, actually, it was right after the Brexit vote. Actually, wait. I did a video right after the Brexit vote and one before it. And I said both of them, it really wouldn't even matter what the outcome of the vote was, because I thought, the people in power in England, when left to their own devices, their methodology, what they learned in universities and stuff, would just go about devaluing the currency and increasing taxes on the private sector and stuff. We're seeing now, though, post-Brexit vote, we're seeing financial warfare, I think, with first the markets attack, probably bank traders shorted the British pound. And then we also saw S&P immediately cut the credit rating for leaving them, saying, they're a credit risk now that they're not ties to European Union. Do you think this is increasing financial warfare that we're going to see in many different countries and governments?
Oh, I think that's a part of it. I mean, London is, you could argue, is the epicenter, the financial epicenter of the world, but certainly that of Europe. There's no doubt about that. So I think the EU will hold that position, hold London as hostage, basically, the financial sector. I mean, they don't have that many bargaining chips when you're negotiating this exit. One thing they do, though, is the access, that London banks have to the continent. And so to the extent that they want to hurt England, that's one area they could. Now the downside is that they're hurting themselves just as much, right? Because they need London, they need the capital. But that's one area that I think would be a trading card that they're going to use here in the negotiations.
Yeah, I heard that the banks in London, the investment bank headquarters like Morgan Stanley and these guys, they were threatening their employees in emails, telling them that if they didn't vote to remain in the European Union, that they were risking losing their jobs, because then the banking headquarters would just move to Ireland or some other low-tax country in Europe.
Well, that certainly doesn't surprise me. I mean, I remember back years ago, I'm guessing it's about 10 years ago, when private equity throughout the United States has what you could argue are advantageous tax situations as far as their carried interest. And the only time you really hear from that community is when that was threatened, and they're calling everybody and, hey, you got to vote against this, or we're signing a petition against this. And so it's crony capitalism at its utmost peak, right? They're the fact that they're so tied to this European integration, these beneficial agreements, makes you wonder. Um, that's the whole reason that they could be at loss. They should have never been in them in the first place.
Exactly. But, the details are coming out that the CIA in the United States were involved in setting up the European Union, and a lot of academics were in favor of it. So, the intellectual class, the intelligentsia, that's what they wanted. And these guys, with their white papers and stuff, they're routinely wrong when they put their theories and ideas into practice, but no one calls them out on it. And, I think that's one of the reasons why the world's pretty screwed up, is we have a lot of bad theories by academia that are still in practice, whether it's Keynesian economics or so many other things. I want to ask you about your background, though, now about Austrian School Economics. It's not very common in the financial industry. How did you find it, and why do you like it?
Sure, it goes back some time. When I was an economics undergrad at the University of Illinois, we were taught pure Keynesian economics, of course. And I was familiar with Milton Friedman and some Chicago school things. I had read, Capitalism and Freedom and Free to Choose and those kind of books. But they certainly made sense, but they didn't fully resonate with me. And then one time, my future father-in-law, and then future ex-father-in-law, gave me a book. It was Mark Skousen's book. I don't know if it's still in print. It was called Economics on Trial. And what Mark did, and for those of you who are not familiar with Mark, he writes a financial newsletter called Forecasts and Strategies. And this book was excellent. And what this book did is it took the leading 10 economic textbooks in undergrad schools, and it critiqued them by subject. And so, for instance, one chapter would be unemployment, one would be GDP, one would be, theories about inflation, etc. And I read that from cover to cover when I first opened it. I was just engrossed by it. I thought it was amazing. It was so insightful and clear. And I realized, I was a senior, that pretty much everything I had just learned in 4 years was worthless. It made no sense. And then from there, I started exploring. I found the Mises Institute shortly thereafter. I started reading the works by Doug Casey. So there was fairly a short time frame until I became what I would consider an Austrian believer. What really appeals to me, though, are a couple things. One is that unlike these other schools, the Chicago School or the Keynesian School, the Austrian School really studies man in the context of scarcity. So it's man's survival. And they start with these basic axioms, such as the nature of scarcity, the nature of man, etc. And from that, they use deductive reasoning to build arguments and a school of thought. And because of that, the school, unlike the others, is extremely, not only powerfully insightful and explanatory, but it's also very consistent. And so you have consistency, and that's a great appeal, both intuitively and as far as its application in real-world economics. And in particular, I'd say there's two areas that are of most benefit to investors if they're not familiar with the Austrian school. And that is that the Austrians have unique explanations as to the economic phenomena of inflation and business cycles. And so I was particularly attracted to business cycle theory, which I don't think many people are aware of, and that they should spend a lot more time reading. And it's quite intriguing.
Yeah, Mark Skousen has Freedom Fest coming up too. I've read a few of his books about how to invest in different types of resource stocks as a value investor and things like that. He's a good writer. I've had him on the program a few times over the years as well. But Freedom Fest is coming up for our listeners. I'm not sure if I'm going to make it this year, but I would like to go eventually. I do really love the Austrian School of Economics. I was telling you about my background and how I found it before the recording. But Economics in One Lesson, I read that. I think that was the first. I read Peter Schiff's Crash Proof first, and then I found the Austrian School through Peter Schiff. And then I read Economics in One Lesson, and I just read that book, cover to cover very quickly, and it just made so much sense to me. The other economic stuff I learned when I started an MBA program and took the classes, it just didn't make any sense at all.
I agree. And, one of my favorite writers, to anyone that's interested in exploring more about the Austrian school, is Murray Rothbard. And, Murray possesses a unique ability in that he has an unmatched, academic acumen, but he's also extremely readable. And the only other economist that possesses that ability, really, is you would say, is Milton Friedman. So, I mean, I would counsel everyone to read anything they can by Murray Rothbard because it's extremely insightful, easy to read, and enjoyable.
Yeah, I read What Has Government Done to Our Money, and I also read his book about America's Great Depression, which, just blows through the lie about how good the New Deal was and what caused the 1929 stock market crash and things like that, and all the stupid things that the president, FDR, and the guy before him, Herbert Hoover, did to make the Depression even worse.
Yeah, that book in particular is one of my favorites, and it's a little bit more academic than his typical writing, but the first 30, 40 pages offer the most succinct and clear explanation of Austrian business cycle theory. So, what causes recessions, and counterarguments as to why critiques of this theory are wrong, why Keynesian economic theories, as far as the business cycle, are wrong. So, if you can't muscle through the entire book, I'd advise everyone to read the first 40, 50 pages.
Robert Murphy also has a condensed version of it. It's a summary with a little bit of added twists on it. It's a politically incorrect guide to the Great Depression and the New Deal, but obviously he cites a lot of the Rothbard book in there too. It's a shorter version of that book.
I'll have to check that out. Bob's one of my favorite economists out there. I mean, he also possesses the ability to write with great clarity, and he's always coming up with interesting arguments that you never thought about before, whether he's coming up with his own theories or just critiquing someone else's writings.
Yeah, I would second that. I've read a number of his books, the Politically Incorrect series, including the Politically Incorrect Guide to Capitalism. That one's good too. I want to ask you now about the stock market and valuations. We're seeing a lot of billionaires either selling stocks and real estate. A lot of them are starting to go really short the stock market. Do you think we're going to see a stock market crash coming up soon in the next 6 to 12 months?
I think there's a high degree of possibility. I mean, we're at valuation levels that are at, by any measure, historic highs. They're right near the historic tops, depending on how you measure it. At the same time, we have a market that's somewhat plateaued. It's been a while since we've hit new highs in the stock market. There's been a tight trading range, for a while now. And on top of that, you really have deteriorating economic conditions. So I know the unemployment rate looks great, but if you dig into the numbers, both for that as well as any other economic metric, things are not doing well. And you could just look at GDP to understand that. I mean, the GDP rate that they publish is hardly what you would consider a recovery type GDP growth number. And so you combine high valuations with deteriorating economic conditions. I think it's ripe for some type of decline in the financial markets, especially the stock market. What the trigger of the catalyst is, I'm not really certain. It could be Brexit. It could be a whole multitude of things. But you're right. I'm not the only one that thinks this. People who aren't Austrians could still recognize the writing on the wall. You mentioned these, titans of finance here, where you have these billionaires like George Soros. Stan Druckenmiller comes to mind. I think Sam Zell, although he's been a bear for some time. And most recently, he had Carl Icahn place some big bets against the stock market. These are savvy investors. And while they may not have the same underlying theory as far as Austrian economics, they recognize a bad deal when one's out there. And you look at the valuations, you look where the economy is headed. Yes, I do think it's quite likely we could have a severe downturn in the stock market. I just don't know what precipitates that.
Yeah, I mean, there could be bank failures, but then, we have the banks that are announcing share buybacks with more debt and dividend increases. So we have potential. There's a lot of black swans out there. In fact, I think there's more black swans than white swans at the moment than that I can see in terms of fundamentals in the global economy.
There's so many black swans that now we'll have to reverse the terminology, right? So the white swan is the unusual swan that's out there.
It's like the Bizarro world, with Superman and Bizarro and things like that.
I am familiar with Superman Bizarro. I grew up watching those cartoons, so I certainly do know what you mean.
Yeah, and I think, one of the main reasons the stocks have risen since 2009 is because of the quantitative easing programs. We've had academic research come out and say, 90% of the stock market increases since 2009 were because of the quantitative easing programs and other liquidity programs that central banks have put into the markets. It's not like these businesses are, growing revenue, improving margins. Some businesses are improving margins, but it's not like, free cash flow across the board is drastically increasing. A lot of the lower PEs are also misleading due to share buybacks as well.
Well, that's absolutely correct, and that's why I think a price to revenue multiple is one of my favorite indications of valuation. And you can see the revenues for the S&P 500 or whatever, however you measure it for companies across the board here in America, have certainly stagnated. And so, where is this margin growth that we did see over the last couple of years? Certainly stopped over the last 8 to 10 months or so. But where did that come from? It's from share buybacks, which you could argue are a direct result of QE as well, financial engineering, etc.
Exactly. Yeah, I think there's not a lot of businesses in the real world, especially the large ones that have a lot of diversification all over the globe in different economies. They're not doing very well. The numbers are just not reflecting that. We're seeing the retail numbers are really bad, and yet the government jobs numbers, like that you talked about the government statistics. I don't believe really any of the government statistics anymore because they said there was job growth in the retail, but then you listen to the conference calls from Kohl's, Target, Macy's, and these guys, and it sounds like they're firing lots of people left and right.
Well, that's true. I mean, the old Mark Twain adage, there's lies, and then lies. I'm forgetting the middle one now. But lies, more lies, and damn statistics. Well, it's really government statistics, right? You can't trust really any of these. And if you look at the big ones like GDP or the unemployment rate, or even the inflation rate, if you just look at those three major ones, I mean, they are rife with errors in how it's calculated. I mean, just inflation is a example. I mean, does anyone really think that we're experiencing negligible 2% inflation? I mean, that's not my experience when you're buying stuff. I mean, everything seems like it's going up in price dramatically over the last several years.
Exactly. And you live in Chicago, so you have high taxes in Chicago in addition to that in terms of property taxes, and you have unfunded pension funds there, and teachers unions that have unfunded liabilities and things like that. So I can imagine that not only are you being killed with inflation in Chicago, like everyone else here in the United States, but you're also getting grinded to death with taxes too. Those are really the two hidden increases there with the currency devaluations. Besides currency devaluation is also the tax increases across the board that people are seeing.
That's right, and that's not in the inflation rate, that's not in the price levels. It's interesting though. The unfortunate thing is not just do we have a high degree of taxes, and obviously because there's high pension benefits or obligations that are out there, but also the problem is that there's a mass exodus from Illinois now with people of money or people just looking for greater opportunities that may or may not have money, and so that's leaving a smaller base of people that got to pick up the slack or are forced to pick up the slack as far as these obligations.
Yeah, I think there's just so many potential black swans. I mean, there are so many unfunded liabilities. Ron Paul just put out an article a couple days ago talking about the Social Security crisis and how badly unfunded and bankrupt that is. I want to ask you now about the rallying oil. You wrote an article on your website, or you had one on your website. I don't know if you wrote it. I saw that it was on your Winrock Wealth Management website. Do you think this rallying oil is sustainable, or do you think that the global economy, with it deteriorating, that people who have made money on the oil rally should consider taking money off the table?
Well, I can't give any particular investment advice, but my thought process would be that this has been a strong rebound, obviously, in the oil price. And just to put it in perspective, oil bounced around the mid to high 80s to maybe 110 for about 4 years, really, until the summer of 2015. And so there it went from about $110, all the way down to just north of the mid 20s. And then it shot up rather dramatically. Now we're at the the $50 level. It's somewhat of a tight trading range. And why has it shot up? That's a good question. Has production really fallen off? I don't think so. You look at the supply that's out there, both being from production as well as storage. I mean, storage is off the charts, which how much is out there. And so my thought process would be, no market goes straight down or straight up. And so it doesn't surprise me that there was a sharp rebound. I'm a little surprised in its length. But given, as you mentioned, the deteriorating economic conditions worldwide, it would not surprise me if oil went down from these levels. Whether or not it gets back down to the mid 20s or even lower, I don't know. But I do think that that's one factor that has not been considered by many investors, is what could happen to the oil price if we had a serious economic downturn. And to put it in perspective, anyone that's concerned or hasn't thought about that should just look at what happened back in '08 to the oil price. I mean, it fell dramatically.
Yeah, there hasn't been millions of barrels per day in oil production cut from the shale oil drillers. The Saudis and the Russians have actually increased production recently. So they're running basically at full blast. Now, a lot of these countries, though, that produce oil and it's their only source of revenue, they really don't have a choice. So if the oil price falls, they actually have to increase to make up the lost revenues. But it's an interesting market right now where, now that the oil price is up, more Wall Street people are bullish on oil. But, back when it was low 2029, everyone thought it was going down. I thought there was value there. Now that we've had a big rally, I don't think there's as much value there.
You're right. You mentioned that a lot of countries are actually expanding their production. That, with the sole exception of perhaps Nigeria, that's certainly true. The oil price from the 20s would go up eventually through supply destruction, to the extent that there's credit facilities that are restricted on these shale companies, et cetera, and they stop actually producing as much as they did before. But that takes a while to develop. And I don't know if we're going to be there until maybe the last quarter of this year, really. So you're right, what's happened has been dramatic, the rebound. I don't know if it really reflects where the oil price should be. I wouldn't be surprised if we go down from here.
I want to transition now and ask you about the precious metals bull market. We've had a huge rebound in gold and silver prices since really December. Do you think, why do you think the rally has occurred in precious metals?
Well, I think there's a number of reasons. I think, for one, is that people don't believe that the Federal Reserve was going to raise rates and restrict their monetary policy of unbridled monetary expansion from the last several years anytime soon. I think they believe that we're going back to the same playbook. And this is not a playbook that's just in the US, but they're doing the same thing, obviously, in Japan and Europe and China. And so I believe at the heart of it is a concern about future inflationary levels. And they're concerned about what's being done to the money supply. Now, on top of that, you have the added effect of uncertainty. So Brexit's a prime example. What gold did literally on Friday was a dramatic increase in the price level of gold. And so gold for the year is probably up maybe mid 30s as far as percentage. The gold miners are probably up 3 times that or so, maybe a little bit less than that. So it's been a dramatic rise. And as always, gold is fueled by uncertainty and concern about inflation.
Do you also think gold's going up because people are losing, people on Wall Street are losing belief that the Fed has credibility?
I do. I mean, no one believes, first of all, the Fed is the worst forecaster if it was in the private sector, they'd have no clients and be unemployed. I mean, they're horrible at predicting where we're headed, and you can see that based on famous comments like Bernanke, whether he's talking about the housing crisis or the fact that in January of 2008, he's stating that the Federal Reserve doesn't see a recession on the horizon. I mean, they are horrible forecasters. And so not only are they horrible forecasters, but we just don't believe, there's so many conflicting reports coming out of them. We just don't believe that their whole concept of raising rates and so-called, restricting or not going back to QE, no one believes them. I mean, because we know that as soon as the economy falls apart, they're going to go right back to that same playbook. We've seen this time and time again. And what they're more concerned about, which is I find shocking, is that they're charged with having reasonable interest rates within the country. They're charged with having of restricting the price level increases, of minimizing inflation, and they're also charged with minimizing unemployment. Well, they've added what I would call a fourth criteria that they're obsessed with, and that's stock market levels. And they do this solely from the belief that somehow high stock market has this wealth effect that's going to spur the economy on to future growth. They're wrong in that. But it's amazing how sensitive they are to the stock market and how sensitive the stock market is to the Fed. It's almost like a binary black hole system, I would characterize it as.
Yeah, I think the Federal Reserve is definitely trapped along with these other central banks. They're damned if they do, they're damned if they don't. They can decide whether or not to let the asset prices crash now or try and delay things as long as possible. I think that's the dilemma that these global central bankers are all dealing with now. They can either let the global economy have a big crash now, or they can push it off as long as humanly possible.
Oh, yeah. Well, I do think they all want to push it off, in the sense that no one's wanted, it's a game of musical chairs. No one wants to be left standing. And so Bernanke timed it perfectly, right? He handed the keys over to Yellen at a perfect time, because that could have, things could have gone down at any moment since she took over. So I think you're right. They'd like to delay it as much as possible, but they cannot forestall the inevitable forever. So I do think we're going to have a significant economic decline, as well as we'll see declines in the stock market, obviously.
Yeah, and I think, if we do have a decline, they'll come in, maybe they'll let the asset prices fall for 6 or 12 months or something, and then we'll have another quantitative easing program or something like that. But I think we're definitely going to have a lot more volatility going forward. Since you're a money manager, I want to ask you about counterparty risk. You put your clients' money, I guess, like in a counterparty. Are you worried about banks failing and counterparty risk and things like that increasing going forward?
Everyone should remember back in 2008, in the midst of the crisis. I mean, everybody that was in the know was concerned about their own bank. Where do you have money? Um, I would advise people that the way they custody their assets is of great concern and something they should be thinking about, in addition to what assets they are buying. So, yes, we always consider that the safety of assets. You can either, choose custodians that you believe could weather a storm and that are strong from a balance sheet perspective, or you could even look at assets that are outside the banking system, or the financial system, I should say, for even greater protection. So, if you own real estate, for instance, then you're outside that system. You don't have to worry about it. So, I think everyone should be concerned about the custody of their assets and the integrity of them just as much as they are as what they're buying.
Yeah, when I speak to different people, a lot of people are all in on certain things. So they're all in on either gold or silver. Some people have, a lot of Bitcoin. There's a lot of counterparty risk if you put all of your money into these types of things. There's ways to diversify yourself and protect yourself. But I think, with what we've seen with MF Globals and with the banking problems ahead and bail-ins and so many other things, is that people have to have at least a certain amount of diversification, because you don't know what the firm where your money's at, or who's storing your gold or something, the problems that they could have.
Well, it always makes sense to diversify. I mean, we don't advocate people so-called putting all chips on red and just hoping for a dramatic downturn in the economy and owning all gold or all of some other assets. I think it's prudent for everyone to diversify across a number of assets. I mean, diversification at some point doesn't make much sense. You can limit your diversification. You don't need 100 different asset classes to truly diversify, but that's something that everyone should do. And I would advise no one to put all their chips on a particular bet on one asset class.
Yeah, and I think we're going to see a lot more currency devaluation going forward, just to keep this merry-go-round going. The Bank of England just released a statement today. I don't know if you saw that. They said more QE is probably coming to devalue the British pound. Do you think then that that's really one of the only tools that these central banks have left?
No, they have more tools. That's interesting you mentioned that, because there's some tools that they haven't spoken about in some time. And by the way, I think it's interesting that they're concerned about devaluing their currency when the whole so-called crisis has seen their currency already devalue by a significant amount. So it's curious that they view that the problem as a solution as well. But no, central bankers have a couple different things. I mean, everyone talks about quantitative easing, which, by the way, I've always thought should really be called qualitative easing, because you're lessening the quality of the currency. You're not really easing the quantity. I think it makes more sense to call it qualitative easing. But regardless, that's just simply increasing the amount of money in the system. So everybody knows about that. Everybody knows about interest rates, right? They set short-term interest rates as far as interbank lending. They can guide, and so lower interest rates have an inflationary impact on the money supply. Well, the third lever at their disposal, which is rarely talked about, is the reserve requirement that banks are required to hold. And so, for instance, a lot of people have heard about fractional reserve banking. For every dollar that's in a demand deposit at a bank, theoretically, you can increase the money supply by the inverse of that reserve requirement. Right now, it's effectively 10% for American banks. And so American banks actually, by lending, have a far greater effect on the money supply than the Federal Reserve does. That's not commonly understood. But that reserve requirement of 10% doesn't have to be 10%. It could be lower. And if they lower it, that can have a much more immediate and profound impact on the money supply than any interest rate manipulations or any QE programs. And I know there's a number of countries, Australia is maybe the most prominent among them, that has no reserve requirement. And so it's not theoretically impossible for any kind of central bank to take this action. I wouldn't be surprised if things get bad enough That's another tool they bring out.
That's a great point. And in 2008, at the height of the crisis, when things were collapsing, I think a lot of the large banks in the United States, they had way below 1% reserves on the bank. They had made all these bets and made all these bad loans, made all these derivatives bets, et cetera, et cetera. So I think it was even maybe 1% of 1%. It was a really tiny amount of fraction. In terms of like how little reserves were on during the height of the crisis in 2008.
Well, geez, that's starting to approach the current day Federal Reserve's balance sheet at those levels.
Well, the Federal Reserve is technically. Have you paid attention to what Jim Rickards has said when he asked the Federal Reserve governor, like in a dinner and stuff like that, if they were technically insolvent, getting their reactions? Oh, we're not technically insolvent. It's funny their responses, the academic.
It's kind of like Ben Bernanke when he's asked in 60 Minutes whether or not he's printing money. He's like, well, we're not technically printing it. It's same thing.
Yeah, well, these guys will get off on technicalities. I just think though that it's smart for people to be diversified going forward, at least some type of diversification. And gold's not cheap anymore like it was 6 months ago or 12 months ago. But people have to be careful out there. I think that's I don't know what you're telling your clients to do right now, but it's a minefield out there right now. I think in terms of buying things, assets that are undervalued.
It's always difficult to buy an asset when it's had a strong and short run up in value. And so I can understand where people may be hesitant to buy gold, but if they don't have a position, I don't think that should stop anyone from starting a position. If anything, you may be more concerned about things like gold miners because they've gone up far more dramatically. You're looking at almost doubling their levels since, December or January. So that may give you a little greater pause, but even then, it probably makes sense to build a position slowly.
Well, Chris, I enjoyed my discussion with you today. If our listeners want to find more of your work and learn what an entrepreneurial-minded advisor is, how do they do so?
Sure. We have a lot of content on our website, which is windrockwealth.com. There's a research and analysis section that has, all of our previous writings and podcasts and et cetera. So I would encourage anyone, really to visit the website, not so much even to learn about us, but learn about our philosophy, which obviously you share, Jason. So I appreciate the time today.
Before I let you go, what actually is an entrepreneurial-minded advisor compared to, a regular stockbroker?
Sure. Well, we're a wealth advisory firm, so we're a fee-based independent firm. And of the firms, there's many firms out there. I mean, it's a very fragmented and large business or industry. However, most wealth managers will only look at certain types of investments that comport to, traditional 70-30 stock bond portfolio that they could tie into certain benchmarks, et cetera. And we just believe in today's era and where stock and bond markets are both eventually headed, that people have to be open to other types of investments. And so we readily embrace things that most wealth managers won't talk about or even consider. But we like looking at things like farmland. Precious metals, obviously we had already discussed, secured private lending, residential rental real estate properties. So I think we're open to more things, and we just have more of I would describe as more of a family office, absolute return mentality than a lot of wealth advisors out there.
Yeah, that sounds good. Most of the conventional stuff is just stocks and bonds based on modern portfolio theory, try to sell you insurance or annuities and things like that. Now, obviously, if you're a higher net worth, you can go to Morgan Stanley or Goldman Sachs and they'll give you a number of different options. But normally the stuff is pretty mainstream. So buying physical gold and rental properties and stuff, they don't talk about investments like that on Wall Street normally.
Oh, they're not even knowledgeable of them. You're absolutely correct. And they're not going to make money on them, not only from the fees of managing that, but also because they don't have their own product typically in those type of asset classes. So it's another disincentive for their sales culture to push that.
Yeah, and I was a salesman like that for a while, and I got my licenses, and then I didn't like the firm I was working at the time, so I interviewed at other firms after the 2008 crisis, and one guy said, dude, this is a sales job. You already know too much. You're going to be asking too many questions. If you don't sell whatever's on the piece of paper, I can't hire you. So I didn't really like that type of attitude and want to work at that type of firm.
Well, that doesn't surprise me. And one of these days, you should do a show where people can compare horror stories, because I've heard them from a lot of clients that have come over in their dealings with some of these firms.
There's actually a best-selling book. I haven't read it yet. It's still in my Audible wish list. I want to get around to it. I've heard it's very famous though. It's called Why Wall Street Clients Don't Own Yachts, or Why Does My Broker Own the Yacht, Not the Clients, or something like that.
I think I've heard of that one. I'll have to check it out.
Okay, great. Well, thank you for your time, Chris, and we'll have you back on again in the near future to talk about markets and Austrian School Economics.
I appreciate it. Thank you.